Hey everyone, Brandon Dunn, associate partner here at NASB. I'm going to go over the three non-forfeiture options on a whole life policy. Things that we see in the field daily. Try to fill in the gaps and help you guys understand some sales angles and how we can put clients in better situations, leveraging the three different non-forfeiture options. So the first one we have is cash surrender. This is what we use, I would say 85% of the time, because most of the time we are able to help people get in a better policy, whether we're getting them more coverage for what they're currently paying, or we're getting them the same coverage and reducing their monthly premium, so getting them a little discount. That's what we see most of the time. That's what most of you guys probably do on a daily basis. Now, there's some times where we can't beat the rate on what we currently have, so we need to leverage the reduced paid up option, which says, hey, I have a certain amount of cash value in my policy. I want to reduce the policy and have a paid up policy. So what that does technically is take that cash value and it buys a single premium whole life policy for a larger amount. It's usually a little bit less than double is what we usually see in the field. And then there's extended term. This one is used very rarely. I believe I've only used it a couple times during my career so far. And I'll get into three different situations where you can use these, but extended term, it's usually when we run into a client who is going to be a guaranteed issue client, and we need to leverage their cash value to buy a term policy that goes for an extended period. And they'll tell you usually in months or years and months how long it'll carry out their existing policy for an extended period of time. So it buys a term policy with the cash value. So to get into some situations, let's just say cheat and get down to a policy review. Say they have, whatever company, ABC life insurance. We find out it's a whole life policy. Just say it was issued in this example in 2021, paying $100 a month for $10,000 of coverage. Cash value $1,000, no loan balance, reduced paid up, a little bit less than double. No smoker rate. So in this case, guys, in the example, let's just say our company is going to offer them $12,000 of coverage for the same premium. In this example, most people are going to want to take the cash value, right? Because we're getting them 20% more coverage for the exact same rate. Most people are going to say yes to that all day long, and they're going to want that $1,000 cash back. All right. So this is what you're seeing most of the time in the field on a daily basis. So we're leveraging the cash surrender value. We get them approved for a new policy that's a better rate or more coverage for the same rate. And then we send them a form to get the cash surrender value out. They cut them a check, mail it to the client, and then it's done. That's how they surrender the policy. That's option number one, cash surrender. All right, option number two, it's a little bit more tricky. Let's just take the same client, good health. We can get them approved for a day one coverage plan. Same company, but they took it out a little bit longer ago. So a little bit longer ago, we're probably, maybe not be able to beat the rate. So we want to look at and ask the reduced paid up. So we're going to, ask all the questions, $100 a month, $10,000 face amount, cash value, this time is $2,500. It's been about 10 years since they've had it. So built up about $2,500. And we ask, hey, what's the reduced paid up amount? So in this case, say it's $5,000. So they've already paid up half of that policy. Reduced paid up is $5,000. So in this case, let's just say the company that we're going with, well, we can't beat the rate. We're seeing when we do the quotes, it's $100 a month for less coverage. The client's not going to want to go down in coverage just to get some money out. Sometimes they will. But in this example, they really wanted to have at least $10,000. So what we can do is we can leverage the reduced paid up, with the current plan that they have, add them together. So we're actually at $12,500 for the same $100 a month. So we took our new company the new company we're going with, add the reduced paid up, which remember, it's going to drop the existing policy down to a reduced amount. They never have to pay again. And this is how you're surrendering it with the second non-forfeiture option, which is reduced coverage, but it's paid up. But guys, I want you to understand, this is confusing to the client. It's confusing to a lot of you guys in the beginning. So it's definitely going to be confusing to the client. The way I communicate it to the client, I don't do this. I don't write all this stuff out. Let me show you the way I communicate to the client. This is all I write. I write the new total amount, the total amount being paid out. This looks a lot better when you compare what they have, $10,000 for $100 a month, and you write in 12,500. Hey, Miss Johnson, I just got you a 25% bump in your insurance coverage for free on behalf of that insurance carrier. So when you compare this next to what they have, they're going to say yes every single time. Now, if you try to explain it like this, confused mind says no, clear mind says go. So I want you guys to show this with the client. It's a lot more clear, concise. Everybody can understand. They see that bigger number, same payment. Absolutely. Do that for me. That's the reduced paid up option. All right. Now let's go to the extended term option. So in this case, guys, this is going to be most of the time, it's going to be a guaranteed issue example. So a guaranteed issue client. So let's just say, they said yes to a bunch of things that's going to make them a guaranteed issue. We get down, we do a policy review, and we're like, oh crap, like I can't help them out. They already have coverage, and you're worried about, maybe I can only add on. Guys, it's not the case. And this is why it's very important to send up the client sheet in every situation and do a carrier call in every situation. Send it up to your group chats and your managers, because in the beginning, you're not going to see all the angles, but we will if you communicate what's going on in the house. So let's just say the carrier's initials are CP. We all know who that's going to be. And I think all cases, this is what when I've used extended term, it's usually been CP or LH. Everybody knows what that means. So let's just say they took it out, 4 or 5 years ago. Again, $100 a month for $10,000. They have $1,500 of cash value. I'm not asking reduced paid up. I mean, you can ask both. I don't care about reduced paid up in this situation. What I want to know, hey, how much extended term do they have in this policy? And what that means, guys, they told me 35 months. All right. So that means we can switch this to extended term. That buys a term policy for 35 months for $10,000. The face amount stays the same in the extended term, whereas in the reduced paid up, it reduces the face amount and it's paid up, but extended term keeps the same face amount for the extended period of time that they will tell you on the carrier call.